And thank you for joining us for today's Successful Strategies for Retirement seminar hosted by St. Mary's College. I'm Courtney Bennett, Plan Giving Officer at the college. Our Plan Giving Office is co-hosting today's event with the Office of Alumni Relations. If the pandemic has motivated you to put your financial house in order, you are in good company. Media outlets are reporting a spike in financial planning activities with people trying to understand and plan for the impact of the pandemic on their financial futures. During these uncertain times, strategies for retirement planning are more important than ever. This seminar will provide you with concrete information and strategies to plan for a successful and stable retirement. We're fortunate today to have the expertise and insight of our presenter, Jon Elfin. Jon is a registered investment advisor. This designation means that he's a fiduciary, the highest standard in the industry, and legally obligated to act in his client's best interests. Jon has been a financial advisor for 19 years and is currently a partner with Open Advisors. He has strong St. Mary's connections. He received his MBA from the college, and his daughter received her undergraduate degree from St. Mary's. Jon has also taught a class on retirement planning for the college. Jon also has a specialty in financial planning for families who care for people with special needs, and his volunteer activities align with his specialty. He's a founder and board member of Sunflower Hill, a community for special needs adults. He's been a Special Olympics coach for 18 years, and he was chairman of Valley Care, which is now Stanford Health Charitable Foundation. Please welcome Jon Elfin.
Well, thanks so much, Courtney. Happy to be here. Thanks for having me. We only have an hour or so. I'll speak for about 45 minutes. We'll touch on a number of issues. Typically, when I give presentations, it's interactive and I take questions during the presentation, but I think in this circumstance, it's probably better if you just put your questions into the chat box, and at the end of my presentation, I'll address those. If I can't address your specific situation, I am going to offer a complimentary consultation, and I'm happy to meet with you individually to address those questions. So ultimately, and actually before I do that, let me share my screen and get the presentation available for you. Okay, so ultimately retirement planning begins really early, and the people that I know that started planning and say contributing their contributions to their 401k or IRAs or Roths in their 20s and 30s are all in good shape at retirement time. But I'm betting that there's few people on the call today that are in their 20s or 30s, so let's focus on some key dates to start off. This is just a disclosure I need to show you. Okay, so starting at 50, most people that I know that turn 50 sort of do so with dread, but I always like to remind them that there's a good side of that, and that is you can do your catch-up contributions. So at 50, you can contribute another $6,500 to your 401k or 403b for a total of $26,000. And another $1,000 to your IRA or Roth IRA for a total of $7,000. 59.5 is the earliest age that you can withdraw money from your IRA or 401k assets without penalty. Keep in mind that anything that is withdrawn is taxable income, but you wouldn't have a penalty at that point. 62 is the earliest stage that you can start getting your Social Security retirement benefit. And keep in mind that every year you delay taking your Social Security, you get about an 8% raise. And I'll talk a little bit more about that later, but I'll just say that in general, it's a common mistake that I see of people taking their Social Security too early. Age 65 is important because that's when you apply for Medicare. Now, if you're working and you're getting your health care from your employer, then you're not necessarily going to claim Medicare at that time. But if you're not, you want to make sure that you apply on or before your 65th birthday, and there's a little bit of time after that. But if you're too late, you're penalized, and it's a really heavy penalty. It's a financial, your premiums will be more, and they'll be more for the rest of your life. So make sure you apply right at 65. 66 to 67 is a time at which you will get your full retirement age at Social Security, depending on when your birthday is. And this is important for a number of different reasons. Number one, if you're going to claim your spousal benefit, in other words, take your Social Security from your spouse's Social Security, you get the maximum benefit, which is 50% of your spouse's Social Security if you wait until your full retirement age. Similarly, survivor benefits are maximized also if you wait until your full retirement age. So for example, if your spouse were to pass away and you took your Social Security as early as age 60, which you can do, you don't get nearly as much as if you waited until your full retirement age. And then lastly, if you're working and you're taking Social Security, if you wait until your full retirement age, they will not decrease your Social Security amount if you're working. Whereas if you take it before your full retirement age, they will temporarily decrease the amount that you get for Social Security. From a retirement side, what we're really talking about here is if you're lucky enough to have a pension, and you might be a state employee or work with a company that had a pension. Most companies today don't offer pensions, but if you have one, it's an important decision, and you have a number of different typically. The first is, do you take it just based on yourself, or do you take it with your spouse in mind as well? Typically, if it's just based on your life, you get a higher amount, but if you passed away, then your spouse will get nothing. Usually there are some options that will say, if you pass away, your spouse might get 50% of your benefit, or even 100%, in which case, of course, the initial amount would be less. Another option is very typically period certain, to where you may take your pension benefit, and it says if you pass away, say within 10 years or 15 years, your heirs or spouse would get the remainder of that benefit. But making those decisions and coordinating them with other parts of your financial situation, like Social Security, is important. Age 70 is the maximum age that you can take required minimum. Is the maximum age that you can claim Social Security, and this is the highest benefit that you will get. What I typically find, and there's a calculation that can be done, is if you anticipate that you're going to live into your mid-80s, it usually pays to delay your Social Security if you can handle that from a cash flow perspective in the meantime. So in other words, you end up getting a higher aggregate amount over your lifetime if you delay it until age 70. And then finally, age 72 is the age at which you have to take required minimum distributions from your 401ks, 403bs, or IRAs. That age used to be 70 and a half, but that changed with the Secure Act at the end of last year. Now, this is a positive thing for people that can afford, that are in retirement, can afford to delay their distributions from their plans, in the sense that it defers taxes for longer, and ultimately, hopefully, your assets will grow more. On the flip side, though, it's a negative for your heirs of a different generation, like your children. So in the past, if you passed away and say your son or your daughter was the beneficiary of your IRA, they could do what was called a stretch IRA or an inherited IRA, meaning they also could take just required minimum distributions from that IRA, which of course would be a lot less than your required minimum distributions because they're so young, and thereby defer all the rest of that asset. It was very powerful. Now with the new law, they have to distribute that. They have to take a distribute the entire amount within 10 years of inheriting the IRA. So if you think about it, if you say you had $1 million, or they had $1 million IRA at the end of the 10 years and they distribute it, it's all taxable income. They'll lose about half of it to taxes. So that's kind of a negative from a from a planning perspective for your family. Now note, if your spouse inherits the IRA, they can roll it over and they can take required minimum distributions based on your lifetime or their own lifetime. So that's not as big a deal, or it's actually no change. Just one other note on this: because of this change of having to distribute within 10 years for an heir of the next generation, I think Roth conversions are more compelling than they used to be. So as we look at this slide, you see a lot of the different components of retirement planning, and it's a lot of things to try to cobble together and put together in a cohesive way. So the idea with that is a very organized process, and it starts with being very specific about defining your different objectives. We then just gather facts and data about your current situation. Then we have to agree on assumptions. You know, what inflation do we want to assume? What are the growth rates of various assets? What are your expenses, including one-time expenses? For example, purchasing a vacation home or maybe college education for your grandkids. What are your different income sources? And, you know, we need to plan for some of the unforeseen hurdles like long-term care events or premature death. Then we start the modeling and analysis. And the core of my modeling is a Monte Carlo analysis, which determines probability of success. And what that allows us to do is then compare that with different scenarios, you know, what if scenarios, and see the probability of success for those things. And so what that allows you to do, it allows you to make more informed decisions. It's obviously not going to be a crystal ball of what's going to happen in the future, but again, it helps you make more informed decisions. So 5 areas that I'm going to go through and talk about that are important to retirement planning are longevity, or how long you're going to live, volatility in the markets, the timing and withdrawal rates of your assets, inflation and taxes, and healthcare costs. So one of the biggest threats to your financial independence is outliving your money. And this is a study that shows a couple at age 62 and the probability of living to a certain age. And you can see, for example, there's a 65% chance that one of the spouses will live to age 85, 40% chance to 90, and 15% chance to 95. And anecdotally, if you think about it, you know, 25 years ago, it seemed like it was really unusual for somebody to live to age 100. Now it's not so unusual. So people are living longer. And you know, I'm going to always want to, and I think you should plan conservatively, because, you know, the last thing you want to happen, you know, great news, you live a long time, but bad news, you run out of money. And of course, we don't want that to happen. So this slide talks about market volatility. And eventually we'll talk about the impact of taking withdrawals from your accounts during market volatility. And you can see that the vast majority of the time the market's been up from 1925 through 2019, about 73% of the time it's been up and 27% of the time it's been down. But as you can see, it's very volatile. Now, as you push out the number of years, and the volatility goes down. And so what this shows is the same data, but rolling 10-year periods. And in this case, you can see there were only 3 times during this period where after 10 years, the market has been down. And as we probably all painfully remember, 2 of those years were 2008 and 2009. Now this chart is of the S&P 500 large cap US stocks. I just want to note that if you had a diversified portfolio that was a mix of stocks and bonds and different types of stocks, for example, you probably were not down in over a 10-year period after 2008 and 2009. And we'll talk a little bit more about diversification here in a minute. So how do we mitigate this idea of volatility? And one of the ways we do that is through this idea of the efficient frontier or modern portfolio theory. And as you look at the vertical axis, higher return is up here and lower return down here. And then if you go to the horizontal axis, higher risk is to the right. So each of these different asset classes have different risk reward characteristics. So for example, international emerging market equities tend to have higher volatility, but higher potential return. And if you go down here to the left, cash or high quality bonds have lower volatility, but lower probable return. And the idea of the efficient frontier is that for a given level of risk, there's a combination of these different asset classes that can optimize your return. And what I have found is that often we're able to nudge up return and even lower risk at the same time. And so what I have found is that not only does diversification tend to lower risk, but also if you have different types of assets in your portfolio, it can also be helpful because those assets have different characteristics, different pros and cons. As Aristotle said, the whole is the greater of the sum of its parts. So diversification not only lowers risks, but it can provide opportunity. As an example, let's say you think real estate is a great investment. I think smart real estate is a great investment too. But I think we can all agree that real estate has low liquidity. So if you get into it, if you're overweighted to just investing in real estate as an example, and you get into a cash crunch, then you're going to have to sell those assets in a fire sale manner and get less for those, and you're probably going to lose opportunity. Whereas if you have a strong liquidity or cash position in addition to those real estate assets, you can take advantage of opportunities or even situations where you get into a cash crunch and need that money. And this slide just really shows sort of how the modern portfolio theory works. So withdrawal rates from your portfolio in retirement is really important. And if you're in the accumulation stage of your investing where you're not taking withdrawals from your investments, you have time to recover. And what this slide shows is that from 1973 through 2019, it shows a 50-50 portfolio of 50% S&P 500 and 50% intermediate term bonds. And one line is what actually happened, and the other line, the blue line, is when those returns were just occur in reverse order. And so you can see that after a really long period of time, you end up in the same place. However, if you're taking 4.5% withdrawals from your investment, it's a very different result. And so the blue line shows 4.5% withdrawals. And so by 2003, you run out of money. The red line shows same thing, only the returns happen in a different order where the returns tend to be higher in the beginning. And instead of running out of money in 2003, you basically die with $5.5 million. So that can actually make a big difference in terms of order of return. The amount that you take out of your investments is also very impactful. So same scenario, but if you were to take out 7% per year, you would have run out of money after 12 years. 6% run out of money after 17 years, 5%, 23 years, 4.5%, that pushes it out to 31 years. And then just by decreasing it by another 5% to 4%, you run out of money after 45 years. So, a rule of thumb in the past has been if you just take out 4% per year, you have a high probability of not outliving that portfolio. I think the prevailing thought now, though, is that given the interest rate environment we're in, it's probably better to plan on 2.5% to 3% going forward to play it safe. Another important factor, obviously, is inflation. You can see that the blue line represents 3% inflation, and the red line represents 5% inflation. So, in 25 years at 3% inflation, the price of goods and services will be roughly double of what they are today. And said another way, if you had $100,000, that would be worth $50,000 in 25 years. If inflation were to go up to 5%, the problem obviously is magnified. The prices of goods and services will roughly triple in 25 years, or your $100,000 would be about $33,000. So because of inflation, you need to have a component of your portfolio that is growth oriented, maybe taking a little more risk, but you need to have that growth. Taxes are obviously another important factor in retirement over the long term. The red line is ordinary income tax history. The blue line is capital gain history. And so obviously we can't predict exactly what taxes will be, but I do think that the probability of tax rates being higher in the future may be greater than the probability that they'll be lower, especially in our current economic circumstances and debt. So the last consideration that I think is really important are healthcare costs, and I think this is on a lot of people's minds, and long-term care. And so the average cost per person nationally of people, annual cost of people who are utilizing Medicare is about $6,000 per year. And the inflation of healthcare has gone up a lot higher than inflation of other areas. It's been about 5 or 6%. So long-term care is another important consideration. And long-term care kicks in when you can't do 2 out of the 6 activities of daily living. And those include eating, bathing, dressing, transferring, toileting, and incontinence. So no one likes to think about these things, but there's a greater chance that you will need them than you won't. So about 7 of people turning 65 can expect to have a long-term care situation at some point in their life. On average, women need long-term care at about 3.7 years, more than men at about 2.2 years. That's because we die earlier. About 20% of people 65 today will need long-term care for more than 5 years. And the average national rate at a Medicare certified facility is over $95,000. In the Bay Area, it's a lot higher than that. So, looking at long-term care insurance or life insurance that has a long-term care component is probably wise, at least to consider in your planning. So how do we deal with all these variables, and particularly the variability of market performance? And there's generally 2 ways that I deal with this. And the first way is the traditional systematic withdrawal program that we were talking about before. What is the withdrawal rate, and is it small enough to be able to sustain you for the duration of your life? And the tools that I use in order to do that are the efficient frontier analysis, modern portfolio theory that I talked about before, in conjunction with the Monte Carlo retirement modeling that I talked about before. And I'll go over that in a little bit more detail soon. The other way is what we call the bucket approach. And what that is where you really have different investment strategies matched up to different needs or different time horizons. And so just real basically, your near-term needs in the next 1 to 10 years, you're going to want less volatile investments with probably lower growth, but more steady, so that you can fund those near-term needs. And conceptually, your longer-term needs, where you're hopefully not going to have to withdraw money from that bucket, and that will be more aggressive, say a more stock portfolio. And so, one of the concepts added to that is that your core needs should be covered by stable sources of income. And then your non-core needs, your lifestyle expense, your vacations, maybe your vacation home, your grandkids' college education, can be funded with less stable and more growth assets. And so if you look at this slide, we kind of break up these different needs. And so again, the core expenses, which are going to be things like your housing expenses, your PG&E, your healthcare expenses. Hopefully, they're going to be funded by things like your Social Security, maybe a pension, maybe a bond portfolio, and maybe even you might order an annuity, a personal annuity to do those things. Your lifestyle expenses, as I mentioned before, the vacation home, your vacations in general, maybe are going to be funded by less stable sources of income and more growth. As you get to the last piece of this, legacy planning, if you're fortunate enough to have a net worth that in today's world is about over 22 million, and it doesn't have to be that high. I just say that because that's the threshold where you're going to have to start thinking about paying estate taxes and want to come up with different strategies to reduce or eliminate those. You may start thinking about legacy planning, whether it's to your favorite charity, your favorite university, for example, St. Mary's, an unabashed plug there. But you kind of think of this as as the Maslow hierarchy of needs, where most people want to make sure they're taking care of your family first. And once that's taken care of, then you can start thinking about charitable giving, for example. Okay, so now the question is, how do we deal with this? How does this all coalesce, and how do we do the modeling to come up with this? And as I mentioned before, I utilize different types of models, but the core is this model that I'm showing here. And what this does is it kind of matches income sources to your retirement planning. And in this particular situation, these people retired at age 65, and the blue is where this is just their earned income. And at 65, they retire, and the purple represents a pension they have. The brown represents their Social Security. And in this case, you can see one spouse started at 65, and another spouse turned their Social Security on at 66. Looks like they have the orange over here is another source of income. Maybe they just had a part-time job in retirement, or they had some rental income. And the yellow represents their withdrawals from your investment portfolio. What you don't want to see is you don't want to see red, because that means you ran out of money. Now, these models do not take into account home equity unless you sell your home. And so this obviously is not a situation that we want to see. So then what we're going to look to do is, actually, before I get into that, so then what are the things that you can do? And really, there's a limited number of things you can do. Number one is you can work longer. Obviously, you can spend less. I don't know too many people who want to actually do that. You can reposition your investments for a higher rate of return. You want to maximize Social Security benefits, maximize any other income programs you might have, like pensions, and then also optimize your distribution strategy. And so a lot of the planning that we do, it talks about, as you go into retirement, where is your income going to come from, and what makes the most sense on an after-tax factor. Other considerations are, as I said, you may want to add a stable source of income by getting a private annuity. You may want to consider getting life insurance if you're concerned about your spouse or maybe your heirs. As Courtney mentioned, I deal a lot in the special needs world, and so invariably we talk about life insurance for the special needs family, because you're really planning for 2 lifetimes in that situation, and that happens once in a while. And then, of course, as I mentioned before, you want to factor in different long-term care situations as well, or unforeseen events. And so by changing some factors and looking at some different strategies, hopefully we can get rid of the red. And this is an example of where we did that. And one thing that comes up very often in today's world, is particularly in California, is the idea of downsizing your home, selling your home, maybe moving out of state, and that will invariably help the situation. And we can see specifically how it will help. Obviously, you have to weigh that against your lifestyle and where you want to live. But by trying on these different scenarios, this is sort of a mathematical way to show probability of success through these Monte Carlo simulations. So the last thing, and this isn't retirement per se, but when we do holistic planning, most people are concerned about concerned about what happens to their family after they pass. And so we do review estate planning documents. We are not attorneys. We work closely with attorneys, but we will do modeling and education around different estate planning, and then also review documents. And so you want to think about who gets what, when, and where, who is the executive or trustee of the estate, who is going to manage the investments, how is income going to be managed, and what is the income strategy for a surviving spouse or beneficiaries. And then, as I mentioned earlier, if you have a high estate, you want to think about ways to reduce your estate taxes, and maybe that's where you're thinking about charitable planning to your charity of choice, university of choice, etc. Just a note, a lot of times, two points here. A lot of times I see estate planning documents that are old, and there have been a number of different changes in the laws. So, if you haven't updated your estate plan in 5, 6, 7 years, probably a good idea to look at it again. The other thing that I find as well is that often people have done their estate plan, they have their will and their trust, but it's not coordinated properly with their assets. So for example, all your non-qualified assets, your homes, anything that's not a retirement account, should be titled in the name of the trust, or your estate's going to go through probate and add a lot of cost and time that you didn't want to happen. Similarly, you want to make sure in your qualified assets and life insurance that the beneficiaries are coordinated with your estate plan. So this really just sort of summarizes a lot of the things we talked about. By the way, there is an error on this slide. The required distributions, as I mentioned before, are actually 72, not 70.5. So I think I actually got through that a little bit more quickly than I anticipated. As I mentioned, I do offer a complimentary consultation. So if you are interested in that, here is my email. Just shoot me an email. We can set up a time to chat or give me a call, and I'm happy to do that. And so what we are going to do now, I'm going to unshare my screen, and we're going to take a look at the chats, and hopefully there's some questions, and I'm happy. I think Courtney is going to answer the questions, and I'm happy to answer any questions.
So this is an opportunity if you had any questions that might be a little more specific with the information that you just heard. John would be happy to answer them.
Any questions about investing, income planning, Social Security, anything? I'm happy to ask specific questions, or I'm sorry, answer specific questions.
Could you maybe talk a little bit more about Roth conversions?
Sure. Yeah, that's a good question. So, the difference between an IRA and a Roth, or a 401k, an IRA, 403b, all have the same characteristic in that whatever you contribute is tax deductible to your income that year, and then the assets grow tax deferred until you take them out for retirement. So it's really powerful. I mean, I always recommend, if you can, from a cash flow perspective, to maximize, for example, your 401k contributions. Roths, which unless your company offers a Roth, have a much lower contribution limit of 6,000 or 7,000 if you're over 50. But the difference between an IRA and a Roth is that you don't get a tax deduction, but you never pay taxes on that money again. And even your heirs don't pay taxes on that money when they inherit it. So it's very powerful. And you can do a Roth conversion from an IRA to a Roth. When you do it, though, there is you have to pay taxes on all the money that you convert to the Roth. So if you converted, say, $50,000 from an IRA to a Roth, you're going to have an extra $50,000 of income. So typically, when we do that, we want to try to do that. We usually do it in stages over the years. But you typically want to do it when you're at a lower tax bracket. But, before the tax law change, because your heirs could inherit an IRA and then defer the taxes through required minimum distributions, a Roth IRA it could still be compelling, but they can't do that anymore. So from a estate planning perspective and passing on your wealth to your children, it is much more advantageous for the child to now have the Roth, because they're not going to pay. They're going to have to still distribute the money after 10 years if they inherit a Roth, but they don't pay taxes on it. So it's a huge benefit to them. So the math works out like through generations, where it's just much more compelling than it used to be.
Okay, thank you. We have a question about a divorce situation and Social Security, and whether you can tap into an ex-spouse's Social Security benefits.
Yeah. So as long as you have been married to your ex-spouse for 10 years, you can still get a spousal benefit. It doesn't matter if they are married. So if your ex-spouse is married again, remarried, as long as you were married to them 10 years, you can get your full spousal benefit. That is not true if you remarry. So I'm not telling you to not get remarried, but that does impact your ex-spouse's benefit.
What about trying to pay off your mortgage?
Yeah, I get that a lot. It really depends on the circumstances. I will say that in general, and this is very general, I always like to get specific with somebody's situation, but in general, during your working years where you're paying higher income, you're paying higher taxes, there's very few tax deductions that you have available. And most of the interest on your mortgage, depending on how big the mortgage is tax deductible. So in general, while you're working, I'm not a big fan, particularly interest rates are so low right now. But as you get into retirement, it's still, paying it off is still less compelling than it used to be, just because rates are so low. I mean, the probability, so let's say you have a 3.5% mortgage rate, which is probably on the high side these days, and good chunk of that is tax deductible. So maybe your effective rate is 2.5%. What's the chance of investing your money and getting higher than 2.5%? Well, it's a high probability, as long as you have a reasonable portfolio. Having said that, I will say that, I've been doing what I'm doing 19 years, and I will say that the people that have low or no debt in retirement are almost universally comfortable, less stressed. So I'm not a proponent of high debt, but I would say in general, if you're working, probably don't recommend it. As you get into retirement, it may not be a bad idea to pay off your mortgage, but it's still, with interest rates so low, it's not, I don't have a lot of religion about it one way or the other.
Okay, thank you. We're getting a question about long-term care. Mm-hmm. At 62, it's really expensive. Are there other options?
Yeah, it's a good question. And so I'm gonna be very general about this. There's generally two ways to get long-term care. One is through a traditional long-term care policy, which is kind of like a term life insurance. You pay your premium. There's different features that you can choose to get or not get. So for example, on a traditional long-term care policy, you'll pay a premium. There is generally an elimination period that you can dial in. Typically it's 90 days, so you pay out of pocket for 90 days if you needed the long-term care. Then there's factors like, how much is your daily benefit? How many years is the long-term care covering? Is there an inflation protection, et cetera? Those are the traditional long-term care policies. And roughly, I'm guesstimating here, maybe 5 or 10 years ago, premiums for long-term care skyrocketed. They tripled, quadrupled. And so those types of policies for most people have become less compelling. It doesn't mean that they aren't, it isn't a good idea for everybody, but they're just much more expensive. And of course, the older you get and the less healthy you are, the higher the premium. What I do see more often, and what I utilize more, is a hybrid life insurance long-term care policy. So it's a life insurance policy, but it has a long-term care component. And there are some that are actually designed for long-term care. And these are usually, I think, much more affordable, but they tend to require a lot of more money up front. So you either pay the whole thing up front in a lump sum, and this can work nicely with somebody who's sitting on a lot of cash anyway, because it's just really repositioning your assets. And those types of policies very often have a guaranteed cash return of, sometimes for a small surrender charge, but a return of cash. Or those policies, you might just have to split the premium between 10 years or over 10 years. So those tend to be a little bit more compelling for most people. So it's really, when I help people with this, we have to factor in, can you afford the premium? Which is the best policy for you? But in general, again, the last 6 or 7 years, any of the long-term care that I've helped people with has been that life insurance long-term care hybrid. It also has a small life insurance component too, by the way. So the good thing about those policies is, at some point in time, heirs are going to get your money back. Whereas with the traditional long-term care, if you don't use it, you lose it.
Great. Thank you for these questions, everybody. We have a specific question about pensions and whether to take a pension as an annuity or a lump sum.
Well, also a good question. And again, I know I'm sounding like a broken record, but it depends. It depends on your situation. And what I do, again, is I model it out to see what looks better. But, components are, in general, I would say that if you have other sources of income that will take care of most of your core expenses, like I was talking about, your housing expenses and your health insurance. So let's just say you had you and your spouse's Social Security, and you maybe had a rental home, and that income covers most of your core expenses. I would probably say take the lump sum. You just don't need that extra guaranteed source of income. On the other hand, it might make sense to, if that isn't the case, it might make sense to take the actual pension option, which just gives you that guaranteed income. As some of the factors that go into this are, how stable is the organization that's offering the pension? Most of them are pretty stable with a small chance, a very small chance of going under, but you are relying on their viability to pay the pension. Whereas if you get a lump sum, it's your own money. Also, there's sort of an in-between scenario where you can take your lump sum and get a personal annuity, which can offer guaranteed income, probably a little bit lower than the pension amount, but you don't give up the principal. So these are all factors that sort of depend on your situation.
Okay, thank you. So we have a question about the 1 to 10, 11 to 20, and 21 plus year categories of investments, and what's the advisable percent that you should aim for?
I'm laughing at myself because I know I'm sounding like a broken record. It depends. It's just a balance. I mean, you have to look at everybody's situation. And I just can't give any more specific advice about that. In general, again, you're going to want to take stable sources of income for those core expenses, but you have to have a bucket that grows as well. So, and another factor in this is age and risk tolerance. So, if you're in your 30s, you should have an almost all stock portfolio. And I know we're not talking about that now because we're talking about retirement. But as you get older and you have, less time to live and also less time to recover, generally your portfolio gets more conservative. Having said that, the 65-year-old that's retiring and says, that has a long lifespan, they're pretty healthy and they have a history of longer lifespan. If they're, saying, gosh, I can't take any risk and I want to be in an all bond portfolio, I'm going to push back and say, you may live another 30 years or another, or even more. And so we need for a component of that to be growth and to be stocks. So again, I know that wasn't very specific, but it really depends on your situation. And again, if you want to take it offline and have a conversation with me, I'm happy to give you more specific feedback for yourself.
We have a question about whether gold is a good asset to have in your portfolio.
Yeah, so I get that a lot after during very volatile times in the economy. Gold is a very defensive asset. And what I will say is this. If you look at gold and on an after inflation, if you factor inflation into the returns of gold over a long period of time, the return has been about flat. It's been about zero. So to have alternative investments or gold, which I consider an alternative investment, as a portion of your portfolio, it can reduce volatility. Okay, so we can consider it, or you can consider it in your portfolio, but generally, in and of itself, I'm not a big fan.
Okay, thank you for that. A question about selling your house for retirement. Is that, I mean, I know it's going to depend, but are there scenarios where you recommend that, others where you don't?
Yeah, no, I mean, homes are very commonly a person's biggest asset or one of their two biggest assets. And people very often have to look into selling their homes. And so, again, in certain circumstances, yes. And I do see a lot in our planning, people planning on selling their home and downsizing, or downsizing to a lower cost state. And that can be very helpful. Another thing is certain people, particularly if you're not as concerned about leaving a legacy or leaving money to your kids, is a reverse mortgage can make sense. So utilizing investment real estate in your home in generally is, I look at having at least a home and even investing in real estate as an important component of somebody who's building wealth. And once you get into retirement and you get older, if that's a big portion of your wealth, you actually probably need to access that equity. And very often that's done by selling your home and downsizing to another home. Or, I've recently had a client that's in her late 70s, and she had a lot of equity in her home, and it's the big part of her portfolio. And I actually recommended not to buy another home, just to sell her home and rent, because that way we could use the proceeds of the home to really fund her retirement. So I think even if you're a lot older, just selling your home and not repurchasing another home could make sense.
Okay, thank you. We also had a question about whether grandparents can open a 529 plan for a grandchild.
Yeah, absolutely. So the grandparents can be the owner, and the grandchild can be the beneficiary. So yeah, I see that a lot.
Okay, and another investing question. What is your recommendation on digital currency?
I don't invest in things that I don't understand really well, so I don't do it. Now, does that mean it's bad? Not necessarily, but I don't do it.
Okay, thank you. These are great questions. Do you have any recommendations in terms of resources like software, applications, or books for retirement planning?
That's a good question. To be honest with you, I probably should, and I apologize for not having that off the top of my head. I kind of focus on my own models and my own software. And so I know there's lots of retirement calculators out on the web. I'm not sure of what they are in terms of books. The one that I always go to, but this is more of a wealth accumulation book. It's an old book, but I really think it tells you pretty much everything you need to know about building wealth. And that is The Millionaire Next Door, which was probably written, I think, in the 50s and has been updated over the years. But other than that, sorry, I really off the top of my head don't have any recommendations. I know they're out there.
All right, we've had a lot of great questions. We really appreciate your interaction with us. We don't see any additional questions right now. Let's see. Here we go.
Okay.
So what is the maximum cash amount per year a parent can give to a child that will not be taxed?
Yeah, good question. So the maximum gifting amount without being taxed is $15,000 per year. So you can do that. So for example, each parent could give $15,000 to each of their kids. So basically $30,000, and there's no gift tax. There's also there's also a lifetime gifting amount. And that amount, and I don't have the exact amount, but it's about, I think it's like 11.5 or $12 million. It went up drastically a few years ago. And that's an amount that can be gifted without being taxed. But if you gift, so let's say you gifted $5 million to somebody, that will impact your estate tax exemption at your death. So, that can be gifted without additional taxes, but it will factor into your estate taxes once you pass away. But on an annual basis, it's $15,000 per donor to multiple beneficiaries.
Thank you. And then some more questions about Social Security. If you work and take Social Security, is that possible? Mm-hmm. And does Social Security get taxed?
Yeah. Oh, two good questions. So the first thing is you can work and take Social Security if you are working and take Social Security before your full retirement age. So let's say your full retirement age is 66 and a half. If you're working prior if you're taking Social Security prior to your full retirement age, then it will reduce your Social Security benefit temporarily. They make it up back to you on the back end, but it will reduce your Social Security. If you are full retirement age, you can work, and it doesn't matter how much you make, it's not going to reduce your Social Security benefit. In terms of taxation, Social Security can be taxed, and it's based on what they call provisional income. And the provisional income is made up of your adjusted gross income, any tax-exempt interest income, plus half of your Social Security benefit. So as an example, if you are making between $25,000 and $34,000, then half of your Social Security benefit will be taxed. If you're making over $34,000, about 85% of your Social Security benefit will be taxed. If you're making under $25,000, then none of it is taxed. So it's this provisional income calculation. But yeah, so that's the answer. I know that's a little technical, but that's the answer.
Okay, we appreciate that. So last call for questions, and then we're going to wrap up our seminar. So we just want to thank you all very much for joining us today here for our retirement planning seminar. And thank you to Jon Elfin for his thoughtful and thorough presentation.
You're very welcome.
We really appreciate your time, Jon, and your expertise.
Okay, and I just popped up my contact information again for everybody if they're interested.
Yeah, we appreciate that. And we're going to be having more online seminars and activities, and we have our calendar up on our St. Mary's website. So please do join us. Thank you again, everybody, and go Gales.
And go Gales. Thanks, everybody.